As we step into a new trading week, the most important question is not where the market will go, but how prepared you are for both possibilities. This weekly outlook is designed to give you clarity, not predictions, so that whatever the market decides, you already have a plan. Let's begin with the bigger picture. Over the past week, global markets showed a measured return of risk appetite, but it was far from aggressive. In the United States, equity markets held their ground as bond yields cooled slightly and investors reassessed the likelihood of future rate adjustments. Technology and growth-oriented stocks found some support, while defensives lagged, a classic sign of cautious optimism rather than full conviction. Europe remained mixed. Growth concerns continued to weigh on sentiment, but the absence of any major negative surprise kept markets stable. Investors there are clearly selective, preferring companies with pricing power and balance sheet strength instead of chasing momentum. Across Asia, markets were largely range-bound. Some economies benefited from stable commodity prices and currency movements, while others remained under pressure due to weak domestic demand. China-linked sentiment continues to act as a cap on broader Asian risk appetite, indirectly influencing flows across emerging markets. For India, this global backdrop is important. We are not operating in an environment of panic, nor in one of unchecked optimism. Instead, we are in a transition phase, where capital is willing to participate, but only selectively and with discipline. Now let's talk about the invisible drivers that often matter more than headlines: the dollar index, global bond yields, and volatility. The dollar softened marginally over the week. This may not sound dramatic, but for emerging markets like India, it makes a meaningful difference. A softer dollar reduces pressure on the rupee, improves foreign investors' effective returns, and eases capital flow stress. It also tends to support export-oriented sectors by improving margin visibility. Global bond yields, particularly long-term US yields, stabilized instead of moving higher. This stability is crucial. Rising yields compress equity valuations and pull money toward fixed income. Stable yields, on the other hand, allow equities to breathe. They give investors confidence that capital costs will not suddenly spike. Volatility, as measured by global indices, remained contained. Not complacent, but controlled. This tells us that markets are alert, not fearful. They are prepared for surprises, but not pricing in chaos. When you combine these three, a softer dollar, stable yields, and contained volatility, you get an environment where risk assets can consolidate constructively. That is exactly what Indian markets have been doing. Next, let's talk about crude oil and gold, because these two assets quietly influence India more than most traders realize. Crude oil remained stable to slightly soft over the week. For India, this is a structural positive. Lower or stable crude reduces imported inflation, improves the current account outlook, and eases cost pressures across sectors like logistics, aviation, manufacturing, and consumer goods. It also reduces pressure on the Reserve Bank of India, giving policymakers flexibility. When crude behaves, it creates space for growth. Gold, meanwhile, remained firm. This reflects global investors maintaining a degree of caution. Importantly, this is not panic buying. It is portfolio hedging. In transitional market phases like this, gold's strength alongside equity stability is normal. As long as crude does not spike sharply and gold does not accelerate aggressively, Indian equities can continue their consolidation with an upward bias. Now let's bring the focus home, to Nifty and BankNifty, the true pulse of Indian markets. Nifty ended the week consolidating around the 26,200 zone. This is significant. The index is not showing signs of exhaustion, nor is it accelerating into a blow-off move. Instead, it is absorbing gains. On the weekly time frame, this kind of price behavior usually indicates institutional digestion, not distribution. The most important long-term zone to track on Nifty lies between 25,600 and 25,800. This is the structural demand area. As long as the index holds above this zone on a weekly closing basis, the broader trend remains intact. Above that, The immediate weekly support comes near 25,900. This is the level that short-term participants are defending. On the upside, resistance begins near 26,450, followed by a stronger supply zone between 26,900 and 27,200. This upper band is where profit-taking and hesitation are likely unless backed by strong flows. The message from Nifty is clear. Above 25,900, the market deserves patience. Below 25,600, the market deserves caution. BankNifty tells a similar story, but with higher sensitivity. BankNifty continues to act as the engine of the market. When it moves, the broader indices follow. When it hesitates, volatility rises. The long-term structural support for BankNifty lies between 58,200 and 58,600. This is a zone where institutional buyers have historically stepped in. The immediate weekly support is near 59,000, followed by 58,500. As long as BankNifty holds above these levels, dips are likely to be bought. On the upside, resistance sits near 60,200, followed by a larger zone around 61,500. A sustained move above this band would indicate renewed momentum. BankNifty's behavior suggests controlled strength, not runaway momentum. This favors disciplined trading, not aggressive leverage. Let's now discuss sector rotation, because this is where many traders either make money quietly or lose money chasing noise. Over the past week, leadership was clearly visible. Financials, especially private banks, showed relative strength. Stable yields, credit growth expectations, and institutional preference supported this sector. Capital goods and industrials also attracted interest. These sectors benefit from stable macro conditions, capex visibility, and policy continuity. On the other hand, metals and commodity-linked stocks lagged. With global commodity prices soft and demand uncertain, money rotated out of these high beta plays. Overheated mid-caps and speculative small-caps also underperformed. This is an important signal. When markets favor quality over speculation, it tells you that smart money is prioritizing risk management over excitement. This is not a momentum market. This is a quality selection market. Now let's look at institutional flows, because price follows money. Foreign institutional investors were cautious but not aggressive sellers. This tells us something important: there is no panic. But there is also no urgency to buy. Domestic institutions, on the other hand, continued selective accumulation, especially in large cap and index heavyweights. This creates a floor for the market. In derivatives, positioning suggests that indices may remain pinned near key levels unless a strong macro trigger appears. This often leads to choppy intraday moves that punish emotional trading. The flow picture supports consolidation, not breakdown. Next week, several key events can influence market direction. Global inflation data, bond yield movements, dollar strength, crude oil behavior, and corporate earnings will all matter. Even one surprise can shift sentiment quickly. Domestically, RBI liquidity signals and commentary around growth and inflation will be closely watched. Markets will react more to policy tone than to data points alone. This means next week could be calm or decisive, depending on triggers. Let's talk about market psychology, because this is where most mistakes happen. This is not a fear market. This is not a euphoria market. This is a discipline market. Participants are willing to buy dips, but only at meaningful levels. They are willing to sell strength, but not panic sell. Breakouts will be tested, not chased. False moves will be punished. In this environment, traders who respect levels and size their positions survive. Those who trade opinions get whipsawed. Now, let's discuss a watchlist, strictly for education. Large private banks remain important to track. Their behavior often signals broader market intent. Export-oriented IT companies deserve attention as long as the dollar remains stable and global demand holds. Downstream energy and refining names benefit from crude stability. Select industrial midcaps with strong order books may perform if capex momentum continues, but position sizing is critical here. The key lesson: use index levels as your risk anchors. Stocks follow indices, not the other way around. So how should you approach the coming week? If Nifty holds above 25,900, maintain a constructive mindset. If it approaches 25,600, reassess risk. If BankNifty stays above 59,000, dips remain opportunities. Below 58,500, caution is mandatory. Avoid over-leveraging. Avoid chasing breakouts. Let price confirm before acting. This is a week for process-driven trading, not emotional decisions. Global cues are supportive but fragile. India is consolidating at higher levels. The broader structure remains intact above key supports. Sector rotation favors quality. Flows are stable, not aggressive. Discipline matters more than direction. If you trade with structure, the market will give you opportunities. If you trade with emotion, it will take capital. That's your complete weekly market outlook. Prepare well. Trade responsibly. We'll reassess again next Sunday.